Welcome to the HFR Podcast. My name is Anika Akil, and I lead HFR Media. HFR is the established global leader in hedge fund data and analysis since 1992. To learn more, visit hfr.com. Welcome to the HFR Podcast. My guest today is Jill Cetina, an executive professor of finance at the Mays Business School of Texas A&M University and associate director of their commercial banking program. She's a regular invited speaker at banking and policy conferences, as well as a prolific researcher. Her prior experience is extensive and very hands-on. She served as a financial economist on U.S. Treasury debt management, working on Fed credit facilities during the great financial crisis at the Dallas Fed, in both banking supervision and monetary policy roles. In the private sector before that, she served as Associate Managing Director for U.S. Bank Ratings at Moody's. Jill is a CFA charter holder, and last but not least, she is a mother of two. Jill, thank you so much for joining us on the HFR podcast today.
Thank you for inviting me, Anika. I'm really pleased to chat with you about stablecoins.
So let's kick it off with what sort of structure you use to think about the role of stablecoin in financial intermediation.
So thanks for that question. I think first it's useful to kind of back up and think about from a broader macro finance perspective, what are the challenges that stablecoin seemingly is trying to address? And I think one of the things that really stands out is the fact that, basically we for 50 years had a system in the United States where treasuries were held to a significant degree by foreign central banks. And foreign central banks were recycling, if you will, they were recycling export earnings. We had significant trade flows. That was part of, I'll call it the post-World War II order. And those foreign exchange reserves held by foreign central banks were very stable money. And they were invested, across the treasury curve, but also in terms of long-dated treasuries. And I think what's interesting is with the changes that have happened with regards to trade policy, we can argue about whether, that system had some downsides for the U.S. Clearly, it did create some erosion of the manufacturing base in the U.S., but the way in which we are sending a message to other countries that we want to have more of a trade balance and that reserve accumulation, it should go away, that we will put high tariff rates on countries that have significant trade surpluses with the United States, I think speaks to a world where we will have less, I'll call it, fewer holders of treasuries that are not mark-to-market sensitive. And this brings to the point, we have at the same time, as I know many listeners are aware, government debt to GDP of over 100% and growing quickly. And I think one of the things that's very interesting is that basically we are now watching the government potentially shift. And we saw this in the most recent Treasury quarterly refunding announcement in July. Treasury wants to rely more on bills, Treasury bills, in terms of financing itself. And this is important because then the question becomes, well, who's going to, be the investors in those bills? And, for the avoidance of doubt, it is when we're talking about local currency debt, it is the case that the government, when the government runs a budget deficit, it prints the money that ultimately finances that deficit, when it's borrowing in local currency. And so I think this is not, it's a little less alarming than when we talk about countries that borrow in foreign currencies. But my point, Anika, is that this financing that is going to be more tilted by the Treasury towards the front end, it will compete with bank deposits. And this is the classic crowding out problem, that when governments are highly leveraged, they end up crowding out the private sector and potentially draining deposits from the banking sector. Now, if we just had Treasury straight up issue more bills, and we saw deposits decline in the banking sector, we would say, aha, crowding out, classic problem. But once you inject stablecoins into it, then it kind of starts to complicate, I'll say, drawing that causal link. But at the end of the day, I do believe that we are in clearly the crowding out scenario. It's just there's a couple of steps now with stablecoins being created under the Genius Act that make this, I'll say, inference a little bit more tricky. But that's kind of my big picture view. And so we've moved also, I would say, from a world where we had, again, not particularly mark-to-market sensitive foreign central banks, significant holders of treasuries. We had insurance companies in the U.S. also, historically were more significant holders of longer dated treasuries. There's a reason that it's valuable for Treasury to issue these, longer dated instruments. And that is they offer, to use the term that I teach students when we talk about fixed income, they offer positive convexity. We all know from our intro undergraduate fixed income course that treasuries have a unique superpower, which is the positive convexity they offer, the asymmetric returns, because they're option free. And that's what long dated treasuries offer the market. But instead, as we shorten the weighted average maturity of the treasury market, which seems to be this administration's intent, we are setting up more of a direct competition between bills and bank deposits. And stablecoins get thrown in the mix here, but that is a big picture of what's on the table. That we have really changed international capital flows as a result of tariffs. We've sent a message to Asian central banks, in particular, about you need to stop FX reserve accumulation and permit trade balances to adjust. And the outgrowth of that is that now, yes, we will always print the dollars that land on somebody's balance sheet to finance our own deficit. But the question is, are those mark-to-market sensitive balance sheets? Are they flighty balance sheets? And I think the answer to that is yes. And then also, is it crowding out?
That is very helpful. It does cover about 2 of the follow-up questions I had. So that works. I also want to dig into the interaction of what the Treasury is doing with the Fed's job. So do you think that the Treasury strategy decreases informational efficiency in the market and makes the Fed's job more difficult in shepherding long-term inflation expectations?
Yeah, that's an interesting question because as we reduce long-term Treasury supply, that can have an effect on the term premium. And I think, unfortunately, there's a dimension in which fiscal authorities have learned a bit from QE, which is, if we affect changes in the weighted average maturity of the Treasury market as the issuer, perhaps we can affect, long-term rates at the back end. This began to some degree, I would argue, under the Yellen Treasury and seems to be continuing under this Treasury. And I think it's very, I'll say risky in some degrees because, we see some of the risks, have already manifested for the U.S., right? Where, instead of borrowing when the 10-year Treasury yield was at 61 basis points during COVID, instead of borrowing more, we had the Treasury do more in bills, drive long-term rates down. And now we have very significant interest expense when we could have saved money. There's been many people who've made this point. And so the current administration, in choosing to not increase coupon sizes at the most recent quarterly refunding, is effectively betting on a Fed rate cut. I, at an earlier point in my career, was a part of the Treasury debt management team. The historical mantra was, you try to borrow across the curve when the deficit is structural. I think these are structural deficits that we're looking at. And so when you shorten the maturity profile, seemingly it is an interest rate bet. I think it was very interesting as well to see the Treasury Borrowing Advisory Committee at this quarterly refunding, Anika, talk about, well, maybe the optimal debt structure is a lower WAM. Well, when you pass the Genius Act and you try to create demand through stablecoin legislation, that is much shorter in duration. Yeah. But that actually is government policy driving, the debt structure towards a shorter WAM, as opposed to that being, I'll say, an organic, development.
Absolutely. So do you think that there's a thought that somehow the formalization of digital currency in the form of stablecoin will add a new tool to the Fed's toolbox for unconventional monetary policy down the line?
I don't think so. I do think that what is very interesting and to some degrees concerning, I think not some degrees, it is concerning, is the fact that, what we're talking about or looking at in terms of stablecoin is arguably the privatization of the US dollar payment system. And, up until this point, there's a mix of public and private payment systems, but you always have FedWire, you have Fed ACH that are very significant. With stablecoins, this is a open architecture. And by that, I mean, these are effectively payment systems that are existing on multiple blockchains. And they're owned by private, publicly traded companies. And while I think there can be tremendous innovation in private companies, payment systems they provide a public good. Okay. And their risk management is of paramount importance to stability in the financial system. And so I think it's a real question, right? Whether, over a longer period of time, as stablecoins grow, whether there will be the desire to continue to invest in risk management needed to keep them stable, as their name implies, versus public institutions, which, are very focused on that. I think an interesting analogy here is to look at what happened with NASA and SpaceX, right? NASA began to rely on Boeing and SpaceX to bring, NASA astronauts to and from the International Space Station. And we had both reliability problems with regards to Boeing. And then, of course, everyone probably remembers the famous moment where, there was the discussion about, well, maybe SpaceX won't bring the U.S. astronauts back, and maybe SpaceX will redomicile itself outside of the United States. This is the problem when you rely on private companies who may or may not, in the longer run, have the public interest. The public interest is not necessarily first and foremost in terms of their objective function. So I think that there's a lot of risks to what I'll call this privatization of the payment system.
So can you elaborate on that in terms of the banking system? Do you think that stablecoin increases or has the potential to increase systemic risk in the banking system? And to what extent are we equipped to deal with that today and in the future?
Well, I think there's a very important, again, going back to my framework, when the government is providing positive convexity assets in terms of its debt issuance, it's not competing with banks. When it's providing very short-term instruments, and those are going into stablecoin, that is, in my view, deposit competition, because those are very like for like. And I think what's interesting is the stablecoin model effectively is very similar to providing full insurance. These are collateralized by T-bills. We'd like to talk about risks with this collateralization structure. But, we don't have full deposit insurance in the US banking system. So, for smaller banks, this is, I think, a very significant competition. And we, after SVB, after Silicon Valley Bank's failure, I think we never came back to a question about, is deposit insurance reform needed? Okay. That question came very poignantly in 2023. And then it's sort of died down, but I view it as unresolved. For small businesses, as we know, were concerned about their transaction accounts. We had the movement of deposits out of smaller banks and into GSIBs. This could happen again and be very destabilizing. And, people can sort of say, well, who cares? Who cares if we don't have all these small banks in the US? I care. And the reason that I care about smaller banks in the United States is the following. We do not have a culture like in Canada. Canadian banks, we have just a handful of large banks in Canada. And the regulatory expectation is that they are everywhere on the ground in Canada. And if you go to Canada, even remote parts of Canada, you will see that is true. You will see the presence of large Canadian banks throughout, even in remote parts of the country. We do not have that kind of a regulatory framework around the U.S. banking system. Some of these places like Utah, other parts of the U.S., as community banks die, it is not the case that larger institutions are stepping in to sort of fill that void. And so I think it really creates risks that credit intermediation, becomes patchy in the United States, that there's an urban-rural divide. I think these are very important consequences that come out of creating this kind of deposit pressure. The US GSIBs will be fine. It's already the case that the stablecoin issuers deposits at the GSIBs are things that can count towards, payment stablecoins, and that they have deposit relationships with the US GSIBs. But the cost will come for community banks and regional banks and the credit intermediation that they provide to their communities. And I don't see stablecoin issuers and I don't see GSIBs stepping up in terms of providing that credit. And that's where I come back to my crowding out thesis.
Definitely. So I'd like to hear more about the collateralization risks that you just mentioned.
Sure. No, thanks for coming back to that and reminding me. I think one of the things that's a really interesting question to ask is, how people have thought about the risks, even for bills. If you get to a scenario where, where the Fed has to rapidly raise interest rates. We sometimes have a tendency to, think about a business model mostly based on where we are and not try to pressure test it to different macroeconomic scenarios. And I think, if you look back I was looking back this morning before our podcast at some of the data around the bill market, say in 2022, when it became apparent to the market that, inflation had gotten away from the Fed, that the Fed was going to be needing to raise the federal funds rate. And I've not seen, a study that has done this in light of the Genius Act passing. But I think it's a really important question to sort of go back and say, given the investments even in T-bills, what kind of changes in Fed expectation would tend to cause this business model to break down historically? And, are we setting any kind of capital requirements behind these businesses? And yeah, these are not long duration Treasury securities, but still, if you have a shock in terms of Fed expectations at the front end and a repricing in the bill market, I think 2022 is an example. There may be other historical examples where you might not be one for one anymore, right? In terms of having that full stablecoin backing, and that gets you to the run risk of these types of instruments.
Absolutely. So final question, net, who are the winners and who are the losers in terms of stablecoin?
This is an interesting question. Okay, so I think some of the losers, unfortunately, as I've already alluded to, are banks. There tend to be the smaller institutions. I think for the reasons I alluded to, I'm more optimistic about the GSIBs adapting to the stablecoin environment. I think, unfortunately, shortening the weighted average maturity, which I think this kind of feeds in, I'm a bit concerned that the taxpayer may ultimately be a loser because we're effectively, this is enabling us to take more risk in the treasury market. We'll have a higher variability of interest expense potentially associated with, a more stablecoin finance treasury market, and the potential for, more shocks from that. I think, in terms of winners, obviously the stablecoin firms themselves, if you listen to some of their, I'll say, recent interviews, they talk about trying to really build, and that they have potentially significant moat around, by making this space regulated. And I want to recall for people listening to the podcast that, FTX and SBF, before things unraveled there, we're also very much on this train of we're a regulated firm, and we want all of these things because regulation can create moats and can create opportunities. And I think the thing is that for these stablecoin issuers, they will potentially become so significant. I mean, the two stablecoins that exist today already hold more treasuries than South Korea. Okay. In terms of their treasury holdings. So can the US government effectively regulate an entity that has that much sway, if you will, in the treasury market? I think is a really important question. Maybe now at the beginning, easier, but over time, as their market share, both of global payments in dollars and their share of the treasury market grows, my question is whether we potentially encounter something like the Fannie Mae Freddie Mac problem, which is, that the entity becomes very systemic. It's a non-bank, and, is that regulation able to be fully effective? So I think that the stablecoin issuers are definitely winners. I do think another thing that we may see come from this is, that this facilitates AI and the privatization of the internet. Many websites today are being scraped by AI and not receiving compensation. And so if we want to move to a model where a ChatGPT search requires some payment of the websites whose content is being used to, I'll say, distill or produce an AI summary, stablecoin facilitates that, but it also changes completely the architecture of the internet and information. And that's like really the last point that I want to leave you with. I mean, you may have other questions, but from a big picture, I think one of the things that is so striking to me is stablecoin has sort of appropriated what began under the cryptocurrency mantra, which what was cryptocurrency about? It was about hard assets in a world where fiat was looking shaky, and it was about decentralization. And what stablecoins do is they take the blockchain and they effectively are using that to create centralized payment systems that are still backed by fiat. So that's the irony here. It's kind of a leveling up of fiat to a higher speed, that can potentially be programmable. And I think there's a greater risk of cyber, a greater risk around that speed that we've not really, I don't know. I'm concerned about that as well from a financial stability point of view.
Jill, thank you so much. This is powerfully thought-provoking. I am so grateful for you for taking the time to be with us. Thank you for joining us.
No, Anika, thank you. And I hope, a few of my thoughts are helpful to, both you and the listeners.
Absolutely.